In this video, we are going to walk through the construction of cash flow statement using indirect method. Right? Constructing cash flow statement using indirect method involves several steps. Step number one, you have to compute changes on balance sheet account. Step number two, you have to classify these changes into the corresponding section in the cash flow statement. Step number three, you need to determine whether each change represents a source or consumption of cash, right, based on the equation or matrix that we have seen previously. Then you just kind of put everything together, okay? So we take here several balance sheets, right? We have basically two balance sheets here, end of month one and end of month two balance sheet that we have seen previously. If you haven't seen the previous videos, make sure you watch them. And so what we are going to do next, we compute the changes from month 0 to month 1 and from month 1 to month 2, okay? And then we basically work with these changes. So I'm going to remove information that we don't need and move everything to the left here so that we could use some space. Okay, so basically here we have the changes, right, which is the step number one. And then what we need to do is to do step number two to decide which sections they belong, which section of the cash flow statement they belong to, right? So change in inventory and change in receivables belong to the operating section, right? These are not financing, not investing transactions. Intuitively, these are sort of day-to-day transactions when you buy inventory or when you sell on account and then collect cash later. So these are transactions related to the operating section of the cash flow statement. Then we have property, plant, and equipment. That's investing transaction, right? I mean, these are not current assets. These are long-term sort of assets which represent investments. And then we have accumulated depreciation, which is classified as operating activities. It's basically adjusting for an income statement expense item called depreciation expense, right? So, for now you can just remember that, but it will make more sense as we sort of understand the mechanics better. So, yeah, I mean, moving on, we have accounts payable. So change accounts payable is an operating activity. Change in interest payable in the United States under the US GAAP is classified as operating activity, right? Payments of interest, payments of accounts payable is an operating transaction. Changes on notes payable, right, related to long-term debt in this case, is definitely a financing activity. Changes in the contributed capital, well, shareholders provide capital, that's a financing activity. And then we have retained earnings. Well, this one is a little tricky because the change in retained earnings consists of net income and it also consists of dividends, right? So net income was 48,000 and then we had negative 800 dividend payments, okay? So of course that's going to be operations, and this is going to be a transaction with capital providers, financing activity. Okay, so this is something to keep in mind. Okay, and then we have step number three, effect on financial statement. Okay, so again, we don't have to worry about cash. The first change is inventory, right? So inventory here goes up by 11,000. When a non-cash asset goes up by 11,000, we think about it as a consumption of cash, right? So negative 11,000, right? All we're doing is using this formula that change in cash equals to basically change in liabilities plus change in shareholders' equity minus change in non-cash assets, where star means non-cash assets, right? And so when assets go up because of the minus sign in this equation, we think about that as a consumption of cash, right? And it's often intuitive. When inventory goes up, that's because we bought inventory on and that's a consumption of cash. So when inventory goes down, that's a source of cash, right? So in the next month, that's going to be plus 6,000. Accounts receivable went up over here by 8,000. That is a consumption of cash. That's how we think about increase in non-cash asset. Then we have another increase in non-cash asset, which is equipment, right? And then we have a reduction in non-cash assets due to depreciation, right? So intuitively, when assets, according to the equation that we have over here, when assets go down, we think about it as a source of cash, right? So that's going to be a positive adjustment over here. Okay, then we have accounts payable. When payables go up, that's a source of cash. And when they go down, that's a consumption of cash. Then we have interest payable. That's a source of cash. And issuance of notes is a source of cash, of course, and the same for capital contributions. Okay, finally, we have income and dividends, right? So income or earnings, we didn't have anything in the first period, but then we have 4,800. Income is the ultimate source of cash, right? If all income is cash generated, then there wouldn't be any differences between change in cash and net income. But in practice, we of course have accruals. And then we have dividends, which is a negative change in shareholders' equity, and that's thought of as a consumption of cash. Okay, so we have step 1, 2, 3, and step number 4 is basically creating the cash flow statement by saying company name, and then basically cash flow statement. And then we're going to start with operating activities. Right, and we have here month 1 and then month 2. Right, so operating activities include adjustments, right, as we basically determined over here, such as inventory, right, and that's 11,000 negative and 6,000 positive. Then we have accounts receivable, 8,000 over here negative. Then we have accumulated depreciation, right? Nothing in month 1, but a positive amount in month 2. Then we have accounts payable, 11,000 and 3,000, negative 3,000, right? And then we have interest. Payable, positive 200. Okay, that's basically all operating transactions, and of course, something that I forgot over here is that in the operating section, conventionally, we always start with net income on top. We could enter it in the bottom, but better to have net income on top over here, and that will be nothing in month 0 and 48,000 right in month 2. That's a source of cash. Okay, so now we can basically draw the line here and compute operating cash flow, right? In the months 1, that turns out to be 0. Indeed, we didn't spend any cash in connection with operating activities. And in month 2, we basically have 1,000 cash flow from operating activities. Okay, so that's operating cash flow. And then we have typically investing. Activities, right? So investing activities, we only have CapEx, or capital expenditures, which is $24,000, right? And nothing in the second month. So investing cash flow equals to -24 and 0 over here. Okay, and finally, we arrive to financing. Financing activities, or cash flow from financing activities. And that includes a couple of items that we see here, right? So this one, and this one. Okay, so we have debt issuance, 20, positive cash inflow in the first month and not in the second. Equity issuance, 10,000, and then dividends, -800 over here, right? And so we draw the bottom line and calculate basically 30,000 and -800 over here. Okay, and this is financing cash flow. Okay, now we can also compute grand total over here. Total cash flow, right? And that's going to be the sum of operating cash flow, investing cash flow, and financing cash flow. Okay, and so for the first month, that amounts to 6,000, and for the second month, that amounts to only 200. Okay, now if you have done everything right and didn't make mistake, these two numbers should be exactly the same as the two numbers that appear as changes in cash, right? So we still have 6,200 over here. That means we done everything correctly and we are able to arrive to the same number as change in cash. That means, we're explaining change in cash. That's what cash flow statement is about. Okay, so you basically now understand what it's like and what steps are involved in construction of the cash flow statement. It's basically computing changes and then making adjustment to net income to reverse all non-cash transactions, right? And to arrive to the cash flow from operations. If you go back to the original journal entries and classify each journal entry that debits or credits cash as operating activities, you will arrive to the same numbers as well. But what accountants do, they follow the process that we went through over here, right? And if you would like to learn financial modeling for it, if you're going to do financial modeling or something like that, you really need to get your head around cash flow statement, because a lot of people understand income statement, balance sheet. Very few people have a solid understanding of what's behind the cash flow statement. This is really what it is. So you should basically make sure you understand what's going on here. And we of course are going to sort of still work on this as we progress going forward. There are a couple of complications that we will see from time to time going forward, these typically happen when changes on one account that we see in the balance sheet cannot be just attributed to single activity like operating or investing or financing, right? Sometimes a change on account could be comprised of two types of activities, right? Like if you take net property, plant, equipment, which is account that you see typically on a balance sheet by public company, and you compute change on that account, that basically consists of change in gross value of PP&E, which goes up because we make investments, but also it consists of negative change in accumulated depreciation, which we classify as operating activities. So you have to basically sometimes take a change and break it down, right? Retained earnings, for instance, consists of net income plus dividends, and we already saw that, how that worked exactly, right? Mergers and acquisitions are typically, where a lot of this becomes very relevant. So if you take typically two balance sheets by a public company, you compute changes on those balance sheets, you often see that those changes are not quite exactly the same as the changes that appear on the face of cash flow statement. Why is that? Well, most of the time it's because companies either acquired another company or disposed of some operations. I mean, think about what's going to happen when you acquire a company. When you acquire a company, all your assets that you acquire sort of appear on your balance sheet. And so your assets such as inventory and receivables could change because you engage in operating transactions, like you buy inventory, for instance, from suppliers. Or your inventory could go up because simply you bought another company that had inventory, right? So that increase has to be separated out and classified as basically investing activities, right? And that's why changes that you see in the cash flow statement, they are operating change-related operating transactions, excluding any sort of acquisitions or divestitures. All right, so that's basically gives you a lot better understanding of the cash flow statement. One last thing to mention is that sometimes firms have significant non-cash transactions. For instance, you buy a piece of property and finance it through mortgage, through debt entirely, just for simplicity. You might, if you just look at changes on balance sheet account, you might conclude, well, a company invested in property and borrowed money from a bank. And of course, that may be misleading if it's like totally non-cash transaction. So firms need to disclose, are required to disclose non-cash transactions. And typically this happens right below the cash flow statement. You see non-cash transactions, such as leases, for instance, and so on. So something to keep in mind. So this concludes the indirect method cash flow statement and how it's created. And in the next video, we'll talk about direct method cash flow statement.